Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello, everyone, and welcome to the Stock Play of the Day. Today's stock is the iShares Emerging Markets ETF. We'll discuss: should we pass, or should we play? Hello, I'm Brian Overby, the Senior Options Analyst with Ally Invest.
And I'm Lindsey Bell, Chief Investment Strategist with Ally Invest.
All right, Lindsey. Well, markets are setting new highs all the way across all the indices. What do we see going into the markets this week?
Yeah, Friday we had what would you call it? A quadfecta? I don't know, making words up. Anyway, we're the S&P, the Dow, the Nasdaq, and the Russell 2000 all closed at 52-week highs. This morning there was a little bit of pressure on markets, but has since subsided with the Nasdaq and the Russell 2000 in the green. The other indices kind of flattish, at least the last I saw. And so the markets are really taking in stride what we're seeing here, a massive increase in COVID cases. Actually, on Friday, we almost reached 228,000 cases on a daily basis. Was a record high for the country. So really sobering numbers there that continue to come in. But the market is looking past that. You do have to start to wonder, though, if the market's getting a little ahead of itself, maybe a little bit frothy. I know you and I have been talking for weeks now. We're pretty optimistic about what 2021 has to bring. But when we look at this chart here of the S&P 500, we've got the same lines on it as we always do, but we're going back to the beginning of the year. You see the big drop off, peak in February, falling all the way into the end of March before the rebound began. Where are we at today? On the right-hand side of the chart, things are looking pretty good. The market is up double digits on a year-to-date basis. You see, we've been able to stay well above the 50-day and 100-day moving averages. Those are the red and blue lines. And then we look at that red straight line that Brian drew across there several weeks ago or months ago, that marks the top, the high that we saw, the first, really not the first all-time high, but a kind of peak in a high in September there. We came back, tried to come up and down. It's been a little choppy ever since then, but it looks like in the last several weeks, we've been able to stay handily above that. What we would know, Brian and I were talking about, is the yellow line on this chart. That's a 200-day moving average. It's at about 31.51, and the market is pretty extended from that level. So we want to see either 200 days start moving up, or we have to mention there is the risk that the market could come down while it works out that distance. There is, of course, still some uncertainty in the marketplace, but investors continue to look for things like this stimulus bill that we're expected to hear more details on this week. Senator Mitch McConnell and President Trump, they're said to be willing to negotiate with I think it was a $908 billion package that was announced last week. We'll see where they land on that. Certainly, investors are hopeful that we will get a package sooner rather than later. I think a lot of individuals and small businesses and local governments, too, are looking forward to that stimulus bill being passed. We've got news. Brian and I have been talking for the last several weeks about vaccines. It had been a Monday morning news topic for the last several weeks. And that certainly has investors feeling better about 2021 because we get a vaccine out there. You get consumers feeling more comfortable about going out and about and spending money, which benefits corporations and their profitability and the economy, obviously. So there's a lot of things going on this week. We've got Pfizer distributing their vaccine in the UK. We're expecting to get the okay here from the FDA this week on that. And this also, too, we don't talk about yields too often here. We try to focus on the stock market, but the 10-year yield reached 0.97% last week, almost 1%. That's the highest we've seen in the recovery. We've seen spreads widen between the 10 and the 2-year. That's a good sign. That means bond investors are also feeling a little more optimistic about the year ahead. So those are all the things we're looking at. Of course, the VIX, we keep our eye on volatility in this market, right, Brian? It's stubbornly staying above that 20 level, which is the historical, 19 is really the historical average. So it does indicate there is some nervousness from investors. Today, you see it up, even as the NASDAQ and Russell 2000 are in the green and the other indices are flat, I think indicating that the expectation is for this stimulus to be passed, hopefully sooner rather than later, and help combat the rise in virus cases that we have seen, even though, especially maybe I should say, on the back of the weaker than expected jobs report that we got on Friday for the month of November. So take me through the VIX though, Brian, what's going on?
Well, yeah, you summed it up pretty well, Lindsey. Actually, we see the VIX once again. Like I kind of expected this number to be down today. We do have the SPX down a little bit, but when we started the call, we were basically flat. We're down 4 right now. I would call that pretty much an even day. And we see the VIX up 1 point, and 1 point on the VIX index at a 21-point index is a fairly decent percentage for the upside. And we're not seeing any fall off in the futures. The December contract is getting close to the expiration. So eventually this futures contract is going to morph into the actual VIX index, and they'll come in line, because that's just what futures and spot prices do. But then if we go out to January, we're seeing the VIX at 24%. And if we go out to February, we actually see the VIX at 25%. So actually higher in February than we are in January. So the marketplace is still expecting this volatility. Well, it's not really that volatile overall, but they're expecting some volatility going forward. But with the markets at all-time highs, it still is befuddling to see these VIX, these future contracts and the current actual spot VIX index just not coming off. And I'm going to highlight on the chart here real quickly, and I'm going to, until this line gets breached, we'll probably talk about it every week. But right here at that 20 level, in February, before the pandemic announcement, that was basically the high of the VIX. The VIX hadn't really touched, over the last year, the VIX hadn't really touched that 20% level very often. And we still can't breach that. We came down, and you see this little tick mark right at the bottom of the screen. We actually breached it for a second, but then again, now we're back up again. And once again, we're up a little bit more today. So that's the one thing in this marketplace. We're seeing the Russell set new highs, leading the way. The SPX, everything's actually getting a little bit, like Lindsey had mentioned, comparative to the 200-day moving average, we're getting a little far away from that average. So in other words, we're getting a little bit heated in the marketplaces overall. But that nervousness of, I guess, the virus, of the vaccines getting distributed, and also a few other things that Lindsey had mentioned, is still just keeping this volatility index inflated, which just means that there's still a lot of people out there that are nervous about this rally, and they're still using index options to try to provide some protection. And we're going to do a little bit of that today, actually. When we talk about EEM, we're going to look at a FOMO trade. But before I get too far ahead of myself, here's the chart on EEM, Lindsey. Let's talk a little bit about the emerging markets.
Yeah, we wanted to talk about emerging markets today. It kind of continues on the conversation that we've been having about the reopening trade and how investors maybe can think about repositioning as we go into 2021. We've been doing this for several weeks now. Before I dig into the chart, though, I want to remind everybody that we are going to take your questions live at the end of the show. So be sure to type out anything that's on your mind in the right-hand box in the YouTube channel, and we'll get to as many questions as possible at the end of the show. So let's take a look at EEM, the Emerging Markets ETF that we chose for this morning. It's a pretty powerful looking chart. Again, another chart going back to the beginning of the year, right? You see a big fall off when the pandemic really hit hard, and a rebound that has lasted the majority of the year with a big jump up right there in early November. I believe that was probably right near the election, the US presidential election. And since then, it's taken off. In the month of November, it's up over 13%. And that took it positive. That move took it positive for the year-to-date period as well. It has a lot of momentum behind it. You see today the EEM is hitting a new 52-week high. But there could be more room for this trade to run. It hasn't outperformed things like technology or the NASDAQ that have been on a tear all year. And that's because this is an index that focuses on Asia. China is a big component of it. And really, the dollar has a major impact on it as well when you think about emerging markets. So what we're looking at today is, here's the hypothesis. And when you're thinking about emerging markets, when you're looking at this as a potential investment, there's just been better containment of COVID and the virus in China as well as North Asia. And you're seeing that lead to better GDP outcomes, which means they're going to be able to accelerate their economy faster than Europe or the US because they're ahead of us as far as containment with the virus goes. We're seeing that in their economic numbers already. GDP for the quarter ended in September was up 4.9% in China. And that's almost back to where they were prior to the coronavirus kicking off. They were in the 6% range. Industrial production has been rising in October, up 6.9%, much better than expected. Retail sales continue to improve, up 4.3% in October, a little lower than the consensus expectation, but still improving from the September results too. So the consumer is out there spending. Import data has been pretty good. So we'll keep an eye on that. The other thing benefiting emerging markets is continued stimulus around the world. So here in the US, I talked about at the top of the show, we've got a lot more stimulus coming our way. Europe, Japan, everybody is focused on stimulus. The dollar, I briefly mentioned that. That's another pro for the EEM. It's fallen, the DXY, which is what I like to look at oftentimes when I look at the dollar, because it shows the strength of the dollar versus a basket of different currencies. So it just gives you a general direction where the dollar's been. It's down 7% since the end of June. 7%. That's a good thing for emerging markets that oftentimes have a lot of debt that's priced in US dollars. So that benefits them as they're trying to pay off that debt and as they're looking to grow. And the concern with the dollar is people oftentimes say, hey, well, if the US economy picks up, do you expect the dollar to start to rally too? And, we're not really expecting that a sharp recovery in the US dollar, given all the debt that we're taking on here. I think what you're seeing across the globe too. So I think that's going to continue to be, the dollar can continue to be a tailwind for emerging markets. Also, we've removed political risk within the market with the Biden president-elect. So that's another positive thing. Now there could be, with rising cases in Europe and the US, there could be a slowdown in some of China's export data. Obviously, there's a big impact as we're a globally connected economy there. So that's going to be something to watch for sure. We're just thinking this could be a near-term, there could be near-term opportunity within the EEM, just given everything that else is going on around the globe. So we wanted to take a look at it. Also, again, like I said, it's tough. It's kind of that reopening trade that Brian and I have been talking about for a while. So that's kind of fundamental story. As I say every week, there's pros and cons to each security that we look at. But Brian, I know you've been digging around for some option trade opportunities within the EEM this morning. What did you find?
Well, yes, Lindsey, and you're mentioning the reopening. I like to call it the FOMO trades, and we've talked about a few of them. We looked at On some of our educational platforms, we've looked at doing longer term option contracts, buying them as a substitute for owning the stock. People are still fearful, and especially in a lot of these liquid ETFs, like we looked at JETS, which follows the airline, JETS is the symbol, the XLF, the financials. We talked a little bit about this. And that FOMO is actually, well, I'm stealing that from the title of one of our digital conferences at the beginning of the year, where it just means fear of missing out. You have this capital that you want to allocate, but you're a little bit nervous about what could happen to the downside. So how could we still be in the markets without being all in the markets? And that's what this trade is. And this is what it's all about. If I go inside the Ally Invest Options Playbook, you'll see here, there's a section actually in the rookies corner of the playbook that we call buying LEAPS calls as a stock substitute. Now, don't let LEAPS scare you. That's just an acronym. It stands for Long-Term Equity Anticipation Securities. And that's actually what the Chicago Board Option Exchange decided to market them as when they instituted them. But those are just longer term options. Those are option contracts that actually go out over 9 months in time. We're going to go a little less shorter than that because ideally, to me, the fear of missing out thing is the fact that the VIX is higher. That shows to me that the world in general is a little bit nervous about the marketplace. So a lot of people are probably still sitting with cash on the sidelines as we are still hitting new highs. So if we're in liquid underlyings, and liquidity means that we have decent bid-ask spreads in the option contracts, and a lot of these ETFs do, an alternative where you can reduce your risk and know what your risk is, but still get a lot of the upside of basically owning the underlying stock outright is to buy long-term options. So let's look at that trade. We've already mentioned a couple of the other underlyings, and I always emphasize here that on the stock play of the day, this is not meant to be a recommendation. We're trying to learn how to implement these type of strategies inside the playbook that would fit your portfolio. So if you have an industry or a sector that you'd be interested in, this is one way you might think about playing it. We're just going to fictitiously talk about EEM today, okay? So it's a $50 stock, which also helps with the underlying. Oops, I went to the wrong tab here. I need to go this direction. And we see the stock is up, well, it's flat today. 50.95, it was up a little bit more in the morning. And we're going to go out and just to try to get us through these next couple of months, we want to go out further in time. We're going to go out to March. That's 102 days away. And we'll go a little deeper in the money. And that's the biggest thing about this section inside the options playbook. We emphasize that you want something that you could buy as a substitute for owning the stock. That means we're going to use a higher delta option contract. And delta just tells us that if the underlying stock moves 1 point, what should our option contract move? It gives us a theoretical expectation as to what that option contract should move if the underlying stock moves $1. So as I mentioned here, we go out 102 days, going out to that March 19th. That's the third Friday in March. It's the standard expiration. And we see that the 46 strike call, and I'm going to highlight this column here, has a delta of 81. That means that this call option should act basically like owning 81 shares of stock, but we're not going to own it. We're just going to rent it. We're going to rent the right to own it, 100 shares of stock. And that's going to cost us right here. We got 565 by 570. It's still 10 cents wide. It's still a lot wider than the stock. And that's normally the case with almost all option trading. You're going to get wider bid-ask spreads. If you stick to the more at-the-money option contracts, right, they're a little bit tighter markets. But when you get a little bit deeper in the money, that's the biggest battle. Honestly, if it wasn't for the wider bid-ask spreads on a lot of stocks, Apple, Google, Amazon, more people would be buying options overall. But the problem is that the liquidity is an issue when you get deeper in the money. But like I mentioned, on a lot of these ETFs, it kind of makes sense overall. I am now limiting my risk. If I just, not quite, it's a little bit more than $5, but if it's $5, you're talking about 10%. Now, would you have taken a 10% drawdown in March before the pandemic? Yeah, I would have been okay with that, right? A lot of people say like, yeah, that would have been fine. So this is the maximum that you can lose on this trade. And the thing that's also interesting about it is that as the underlying stock goes up, this goes up approximately the same amount of the stock, but that's not quite the case as it goes down. All right, so let me explain that concept, and I'm going to show it in the profit and loss graph here on the Ally Invest option trading platform. So let me highlight, here's the underlying stock, here's the days to expiration, here's the option that we're buying. I click once over here on the Ally chains, it puts it down in what's called our option workbench. We see the midpoint at 570, we'll call it 570. If you just want to buy it, you buy it at 575. So we'll put it in at 575 since it's just a single leg option contract. And we'll make that our official paper trade for the week. So if we put this in, we'd be buying to open one contract at the March 19th expiration, 46 strike call. We'd be paying $575 for one contract plus commission. And that would be our total risk of that trade. So in that instance, then we just click preview order and we'd send that down to the trading floor, and that will be our official paper trade for the week. Now, let me just talk a little bit about what I mentioned on the pricing, and you can use the chains to kind of get a grasp of this. But if I go in and I add one more strike, let's make the 45 strike, and I don't want to get too long-winded here, but you see that if I just concentrate on the ask price, if the stock went up one, the 45 strike or the 46 strike would be basically one more point in the money. And guess what's one more point in the money right now? The 45. So if you see this underlying stock going up one based off of the chains, you would expect this option to be trading somewhere next to where the 45 strike option is. Now, that's if it happens right away. And you see from here, we're talking about approximately an 80-cent move. 655 from 575. Now, let's say the underlying stock went down and we did get the movement down from 51 all the way down to 46, that 5-point movement. That should be trading somewhere where this underlying is at right here. So on the way down, if it went down and became an at-the-money option contract, we're still going to get a lot of juice. So on the way down, it slows down. So right now, the 51 strike option contract's trading for $2. That means pay $575 for it. If it happened recently, if it happened in the near term, right? Because this is a today chain that can change a month from now. These prices aren't going to be the same. But now you look like losing just over half of your investment. So there are two upsides to doing this, and that if I do the FOMO trade, I get some benefit now of the market going in. I got some capital in. I have limited and known risk. The market goes up, I can participate. And as I go deeper and deeper in the money, it acts more and more like the stock. The market comes down, it acts less and less like the stock, right? And all the way down to that strike price. So if I did this trade and the market did come down that 5% or approximately 10 percentage points or 5 points here, which would be about 10%, I'd probably just get out of the trade. That would be my sign right there. I would take advantage of the fact that it's an at-the-money option contract, and then I would go and I'd look for my next trade. But to start with, this allows us to be in the market, allocate some capital, and still, if we get this big upturn so far in EEM, which is a little bit overextended, as Lindsey mentioned, the 200-day on all the indexes are looking a little bit overextended. The width between, or where the 200-day moving average is at compared to where the index is at, is showing a little bit of froth in the marketplace. But if we scroll down and we look at the profit and loss graph here, it kind of highlights that, right? In that everything that I just mentioned was a real short lesson on option pricing overall. And that's one of the hardest things to understand is in the option trading world and become a good option trader is to understand how option prices react as the underlying stock moves, because it has a time component in it. But here's where the underlying stock is being represented, right around 51. That's the gray line. We have the profit and loss graph as of today, which is the actual colored line. And you see it deviates from the dotted line, which is at expiration. So if the market comes down right away, we actually get a nice little buffer, if you will, relative to if it happens closer to the expiration date. So we have 101 days here. Let's go all the way down to, let's make it really egregious. Let's go like 3 days to go to expiration. And now you see it's very similar to the expiration graph. So what does this mean? In the short term, it gives you a little bit of protection to the downside. But on the upside, the dotted line eventually morphs, and it basically acts a lot like just owning the stock outright. All right. Well, that was a little bit more long-winded than I wanted to be, Lindsey. I guess let's get to some of the questions. But we've done 3 of these type of trades now where we've looked at ETFs that have fairly liquid markets and said, this is somewhere you could allocate capital if you wanted to be in these industries, and the markets are liquid enough to do so. All right. First question, Lindsey. We got a couple of them out there. Please feel free to put them in the chat box so Lindsey and I can address them. We got still a few more minutes here left, so we always love to get your questions. So go ahead, bring them.
Yeah, we got a few here, and we're always happy to take them, that's for sure. First up is Murray Conteri. How do you see what appears to be the failure of an agreed Brexit plan affecting European market?
Wow, that's getting into detail.
I mean,
I'll let you have that one, Lindsey.
Huh?
I'll let you have that one. Let's get into detail.
I mean,
That's
I'll just give it my quick 2 cents. I think today you're seeing the sterling down sharply on concerns that there might not be a deal. The UK stocks have underperformed for a while now because of the uncertainty around Brexit. Though I think that this is something that's going to, it's going to create volatility probably in their markets for a little while, but there could be a relief rally also too, just because even if there is no deal, that means at least there's some certainty about which direction they're going finally. Remember, this thing was voted on in 2016. So to be determined, but it's something we'll keep our eye on, but we're kind of have been avoiding just because it's so uncertain. Next up, Albert, can you please have a look at Tesla stock and where you see it from there? Brian, I know you're always looking at this one, and we don't provide recommendations on individual stock. But this has been a hot topic. They split this year. They're now being added to the S&P 500 on December 21st, I believe is the date. And they're actually going to be added to the consumer discretionary sector, not the technology sector, because they're viewed as an auto company. But Brian, I don't know what your thoughts have been on Tesla.
Tesla, I don't know, befuddling. I don't understand, what's going on with Tesla overall? And that, I guess it's a technology company, because if you try to price it as a car company, the numbers are outrageous. And it doesn't seem like companies like GM and Ford can actually get any ground. They got a little bit of a pop-up recently, but obviously nothing compared to Tesla. So it's just, I was amazed that they put it in the S&P 500 index. But with that said, I understand that the S&P 500, the people that run it want that index to go up, and there's not a stronger stock recently. So it's the option contracts overall in Tesla trade at ridiculous implied volatilities. So the short interest number is still really high. The option traders are still really nervous, but it still continues to go up. So are we talking about a car company, a technology company, or is this acting like a Bitcoin? Like, it's just all over the board, and it's really hard to say. So like, if there was ever a stock that I wouldn't want to give a recommendation on, or mainly just because I don't really understand it. The books aren't that great overall, but the company just continues to skyrocket.
I know. I mean, you make a really good point. There is a lot of short interest in it, and I like, the insight you gave us in the options market there, real volatile. I also wanted to mention one more thing about EEM before we get to the other questions we have in here too. The other risk that I just remembered to EEM is last week the Senate passed a bill to prevent listing of Chinese companies on U.S. Exchanges without information, financial information about them. So the President Trump is expected to sign that into law if he hasn't already. So there is like that risk too, but you didn't see stocks like Alibaba or JD.com react too significantly last week when the news came out. But anyway, it's just a risk. China tensions are there. So just something to consider when you think about EEM. But next question, Rag Piano, can you put a MACD comparison chart up to an option chart?
No, we don't have that ability. It's just that simple. That's a short answer. Sorry, but we don't have the ability to do that.
Okay, no worries. Sorry about that, Rag Piano, but thanks for the question. Finally, we got viewers still looking for your midday market call link. You
Okay.
switched over to Zoom.
All right, so here it comes. I'm gonna put it in the chat box to our producer. And Eric, you can move it over there. And it's going to be one more day that we're going to be using this. And then then that number is going to change. But if you sign up, you should receive an email letting you know about it. So let me jump into our chat box and I'll pass it over to our producer and he will be able to put it in there. But we will be doing it tomorrow. And then we've got everything in place to start next week using the Zoom platform, our new Zoom platform, which is a much easier platform to deal with than Cisco WebEx.
Yep, well, that's going to do it for our show, Brian. Just a reminder to all of our viewers that Brian will review this option strategy for EEM on Friday at noon on the Ally channel right here. Stock Play of the Day Overtime is the name of the show. Be sure to tune in and see what Brian has to say after the last couple of days of trade in the strategy.
Yeah, I love that we do the overtime. So please do sign in. It's just a lot of fun to be able to talk a little bit about the strategies. Usually a lot of times we don't get that opportunity. So I enjoy it. So make sure you click subscribe and you ring the bell and you'll get all the alerts for this Friday's overtime. And then we'll see you this coming up Monday for another edition of the Stock Play of the Day. Thanks for coming, everyone.
Thank you.